I wanted to make a video on what needs a second leg, what type of bars and types of contexts need a second leg. There's a lot of different ways to identify stuff that needs a second leg, but I'm just going to go over basically three main ways to pick out what might and what might not get a second leg. And ultimately, this should help you learn how to sit through minor reversals because if you are in a trade and your premise is that we are in a bull trend, it's logical to exit when the bears need a second leg. And if none of the things that I'm about to show you are there for the bears, then they might not necessarily end up needing that second leg. So I'm just going to go over three different ways to identify if one side might need a second leg. As a reminder to everybody, in the members area of my channel, there is my 4-bar micro channel breakout study, about 6 months worth of data, if you're interested in looking at that. So what needs a second leg? The three things I'm going to go over today are surprise bars, and generally in legs 1 and leg 2, consecutive breakout bars, or 3 to 4 bars. And again, the more bars you have in a micro channel, so 10, 11, 12 bars, the more likely it is you're going to get a pullback, and the deeper the pullback can be. So you need to learn how to get a good sense of when enough is enough as far as the depth of or the height of a breakout goes, per se. These first two things are generally very context dependent. Surprise bars and consecutive breakout bars aren't good in legs 3 and 4. They usually make better fades in legs 3 and legs 4. And the more time you spend learning how to count legs, I think the more successful you're going to be. So I might make a video on some point specifically about leg counting, but I think that is probably one of the most important and critical things to know how to do, if not the most important thing to know how to do, is how to count legs properly. And it just takes a lot of time and a lot of repetitions. So I would make a lot of slides. Personally, this is one of the things I've done, made a lot of slides on second legs, third legs, fourth legs, etc., learning how to count them. But surprise bars and consecutive breakout bars are often vacuum tests in third and fourth legs, and they're reliable signals for second legs in leg 1. So that's something to consider. And then finally, there's 3 pushes and a reversal. Now, you could say, isn't that a wedge? Yes, it's a wedge, but wedges are not always reliable. And just because you can identify the wedge pattern does not mean that you should trade it. Wedges are very context dependent because most of the times you get 3 pushes, you should get 2 legs, but they're often minor 2 legs. And you don't really want to trade those minor reversals because the reality is they're very difficult to manage. And especially for newer traders, if you're trying to do that, it oftentimes takes really advanced scalping techniques, and it's not a good idea to be trading counter trend wedges, essentially, basically minor reversals. You want to trade wedges that have more major patterns, and that's something that requires a deeper look into context. So the problem with trading is everything is context dependent. But anyways, I'm going to start off with surprise bars. So surprise bars, this is just for me, by the way, my color coding. We're going to go over to notes in a second, but that's just me color coding the notes, so I'm keeping track of things properly. But a surprise bar is bars generally average than the past 10 to 15 bars. Here is an example. Just look at the green for now. We're going to get to the red and the purple in a little bit, but just right now, look at the green. This is a good example of a surprise bar, but it's a late leg. We have a couple legs down, 1, pullback 2, pullback 3. You could argue there's 4 legs here and a breakout attempt below, or you could just say 1, pullback, the channel is the second leg, and this is the third leg. Either way, anytime you're getting a surprise bar at the bottom of the trading range, you have to be careful. Now, there's still a high probability that 25 is going to get a second leg, but the thing you have to start learning to think about is, what is that second leg going to look like? Some breakouts like this, we're going to go over consecutive bars, etc., in a little bit, but breakouts like this, 30 through 33, this is a leg 1. So this should get a second leg that's roughly the same size as this first leg, right? Early legs and legs low in trading ranges, like a first leg for the bulls, is oftentimes going to get a second leg that is the same length as this first leg up. Like bars 3 and 4, you can see the first leg from the low of bar 3 to the high of bar 4. And then we got a second leg from the low of bar 6 all the way to the high of bar 10, and it was the exact same length. So it's all about context, and 25 should get a second leg, and it did. You can see 29 went went more than 1 tick below the bar 25 low. So once you go 1 tick below the 25 low, you can assume that the second leg has started. But how that second leg looks is obviously going to be very dependent on context. And as you can see, it was one push down, pull back, two pushes down, pull back, and then three, and a failed breakout below the low. So, you have to spend time thinking about what a successful breakout into the second leg is going to look like versus a failed one. Again, once we go one tick above the 34 high during 37, the second leg has started. It becomes a question of how the second leg is going to look. And you're going to have a much better time trading if you work on trading a first leg for a second leg rather than trading a third leg for a fourth leg, something like that. Because legs 3 and 4 are usually very unreliable as far as trading breakouts. Surprise bars often have a pullback when they're in the first leg, and then they end up getting follow through. So we're going to talk about that for a minute. Sometimes it's a channel, sometimes it's a 1 bar pullback, and then the second leg is only a bar or two. But what's important to realize is if you get a surprise bar, big bear bar closing near its low, and you sell the close, you are going to sit through a pullback a lot of the time. And the question is, how deep is the pullback going to be? And you could, one of the nice things about this second leg rule is you can use it as an entry and as an exit rule. So you can enter when one side needs a second leg, and you can exit when the other side needs a second leg. So when you get a bear surprise bar, you can sell the close of it, expecting it to get a second leg. And then if the pullback for the bulls needs a second leg, you can always just exit. So we're going to look at a few surprises that in general are going to get second legs. Surprise bars on the open can be somewhat reliable, but again, they are context dependent. We have a bear channel here and a trend line break, so we should get at least a lower low. And when you get a strong bear bar closing near its low on bar 7, we're probably going to get at least some sort of second leg down. And then you have more follow through on bar 8, so the surprise bar does get follow through. And at what point do the bulls need a second leg? Does bar 11 need a second leg? Well, is bar 11 a surprise bar? Is it bigger than the last 2 to 3, or bigger than the average bar range of the last 8 to 10 bars? No, probably not. 7 is still the dominant feature of this day so far, so I don't think 11 needs a second leg. Is it 3 pushes down? Not clearly, and it's very possible that 7 was a big enough surprise that 7 is a leg 1. So I don't really think that we have 3 legs down at this point. It's not really a very reliable reversal. And is 11 consecutive breakout bars? Is it consecutive bull bars closing near their highs? No, not really. So if you sell this close, you can, or the close of 7, whichever, 7 or 8, it's okay to wait for follow through because these can turn into traps, but I have an example of that I'll show in a little bit. But if you're selling here, it's okay to just sit through and basically wait for the other side to need a second leg. And if anything, you should use these rules in this presentation as exits for your trades, and because it'll help you hold in the always in direction. Really, there's going to be a lot of information thrown at you throughout the course of the video, but I think that the important thing is to try to write down 1 to 2 things to remember. Because the reality is, especially with Al's course, there's so much to digest that you're not going to get all the information on the first go. You have to basically, when you watch a video on Al Brooks and stuff and you're not understanding most of it, you need to pick 1 to 2 things and just write those down. And those are what you're going to try and learn. And then you go back to the video in a week, a month, whatever, once you feel like you have learned those 2 things properly. And then you try to pick out another thing to learn and another thing to learn. So you learn how to learn things in pieces. You're not going to learn everything in one go. So here we have another surprise on the open, and the close of bar 7, it's going to get a second leg down. So you can just sell the close of 7 and expect that you're going to get a second leg, and you can look to exit when the bulls need a second leg. Does bar 8 meet any of the qualifications for needing a second leg? No, there's no reason that bar 8 needs a second leg. What about bar 11? Does bar 11 need a second leg? No, it probably doesn't need a second leg. Again, think about the qualifications. Is it a surprise? No. Is it 3 pushes? No. Is it consecutive breakout bars? No. What about 14? Does 14 need a second leg? Is it a surprise? No, 14 isn't really a surprise. Is 14 consecutive breakout bars? Nope, it's just 1 bar. Do we have 3 pushes down? 1, pullback, 2, pullback, 3. Yes, we have 3 pushes down. You can exit your trade above 14. If you'd rather wait to see if it gets follow through, you can do that. You can wait and exit above 15, but it's definitely credible to exit above 14, thinking that 14 is going to need a second leg up. Does that mean you should buy above 14? No, you should not buy above 14. It's a wedge, but it's a minor reversal. And one of the things that you have to do to learn how to do to be successful is to stop trading minor reversals. We have a good example here on bar 24 of a surprise bar that is a third leg up, where we are always in short. So it's better not to buy. So 1 on bar 11, this is the first leg, pullback, 2, pullback, 3 legs up. So the pullback for the bulls, 11, 17 to 24, is 3 legs up. So if you're buying the close of 24, you want 25 to look similar to 24. Or if you're buying the close of 25, you want 26 to look similar to 24. And instead, you get a disappointing bear bar closing near its low on bar 26. So bulls will probably exit below 26 and bears can sell for a swing or wait for higher probability 27. 27 is also a surprise, and you know that the traders who bought the close of 24 are trapped, so you can sell below 27 and expect some sort of decent move down. Here's an example. Bar 7, yes, it's a bear surprise, for sure, but we have 2 bull trend days on the prior 2 days. So if you're selling this close, you're selling against a bull trend that's lasted from, basically bar 9, so 70, 120-ish bars, give or take, is how long that bull trend has lasted. And if you're selling the close of 5, you're selling, basically betting that the bull trend, means nothing, and it's not going to work. We're going to break out below it, and it's very low probability, really, that you're going to sell this close and you're going to get a swing down. So if it's not great to sell the close, can you buy the close? You can, but I think that sort of trade is probably not something you should do as a beginner trader. Instead, it's better to wait to buy the close of bar 6 and expect a couple of legs sideways to up, or buy the close of 11 and expect a couple of legs sideways to up. And there will be times where you buy the close of 6 and you think that 8 is a big enough surprise that it might need a second leg. You exit below 8 and then you get 11. You can just buy again on the close of bar 11. So if you're gonna trade like this, yes, you're going to get trapped out of trends sometimes, but that's okay because you can buy again and just get back in when your side needs a second leg up. So consecutive breakout bars. When you get strong consecutive breakout bars, particularly in leg 1, you have a very high probability, 85+% chance of getting a second leg in leg 1. However, as the legs go on, the odds of getting that second leg decrease. So when you get into legs 3 and 4, consecutive breakout bars, 2, 3, 4 breakout bars, oftentimes turns into a better fade than it is by the close. That doesn't mean you should work on fading those. It just means that you should work on not buying in legs 3 and 4. Again, to start out, do not try to fade trends on limit orders. It's just almost never going to end well for you. You're going to have to learn how to do that sort of thing, because if you're trying to fade, oftentimes people think they're fading a leg in a trading range, but they're actually fading a trend. It's okay to fade legs in trading ranges, but it's really, really difficult for traders, especially early on, to confidently pick out a leg in a trading range and know that it's not a trend. And if it starts to turn into a trend, know how to quickly take the small loss rather than trying to scale in and piling mistakes on top of mistakes. One of the most important things you can do is not turn a small mistake into a large mistake. So if you make a small mistake, that's fine. Everybody makes small mistakes. Just exit at the market instead and take your small loss, because what often will happen is people will make a small mistake, which is fine. Everyone does it. But then what they'll do is they'll scale into their mistake and turn it into a massive mistake that destroys their month. So you spend a month making up for one really bad thing that you did versus you could have made it back in one trade. So don't turn your small mistakes into large mistakes. If you think that you made a mistake in the market, that's fine. Everyone does. Just exit rather than sitting there and trying to make up for the mistake by making even more mistakes. So you have a very high chance of getting a second leg, but the entry is very, very much based on context. So your job is to find something that is strong enough, as I wrote here. Your job is to find a first leg strong enough for a second leg, find a way to enter, and rather than trading reversals. Traders get too focused on trading reversals, but if you find that you are trading reversals and you lose most of your trades, it's okay to take low probability trades if you take all of them, but it's much more fun to take high probability trades and win most of the time. So if you find that you're taking reversals and you're constantly losing, just trade the breakout before the reversal and hold through the reversal, because if the reversal does not meet the qualifications for a second leg, then you can just hold through it. So in this case, if you buy the close of bar 4, you see bars 3 and 4, I think 85% chance or more that it's going to get some sort of second leg. And as I mentioned, the second leg can often just be leg 1, pull back, and then leg 2. And it's not always an exact measured move like it was in this. So you have 3 and 4, and obviously, like I mentioned, you put it on the low of 6, it becomes an exact measured move. It's not always that way, but your job is to decipher the context of the breakout and decide how to enter. So one thing you can do that, way to gather information on this is every time you see good looking breakout bars like bar 3 and 4, you can just buy the close, or if they're bear bars, you can just sell the close and basically write down the context that you think it is and write down the result. And then once you do that 100 to 200, maybe 300 times, you'll start to figure out, oh, this is a good idea when this and that happens, and it's not a good idea when these other things happen. So that's basically the essence for starting to learn how to trade breakouts. And you'll start to figure out that, well, when you get 3 and 4, maybe I don't buy the close, I buy the pullback, things like that. And you buy the breakout points, the breakout tests, things like that. But that's not something you should do if you're just starting out. If you're just starting out, you should just buy the close of 4 and learn how to sit through the pullback and then exit after 3 legs up. 1, 3, and 4. So this is your first leg, pullback 5, 6, and 7, second leg, pullback 8, 9, and 10, third leg. You can exit below 11 since that's 3 legs up. As a general guideline, the more bars that you get in one, without a pullback, the deeper and more complex the pullback is going to be. So if you get 8 straight bull bars, is it theoretically by the close? Yeah, it's by the close, but if your stop's going to have to be very wide, and you're going to have to be willing to scale into the trade. So you can't buy the close after 8 straight bull bars and just exit immediately. If you do that, then you're probably going, or I should say, you can't hold through half the pullback and then exit. If you buy after 8 straight bull bars and the 9th bar is a bear bar and you get up below it, that's probably theoretically a reasonable thing to do. But after that many bull bars, it's probably better to wait for the pullback, because again, the larger and more extreme that something is, the more likely it's going to pull back. But also the more likely it is that it's going to get a second leg. Here is a good example of that. You can see we have a tight channel, and then we have 3 pushes up, 1, pullback 2, pullback 3. But basically the wedge top, the quote unquote wedge top, is bar 44. But it's a really tight channel up, and nothing 44 is really doing should get a second leg. Because of how far down this was, we probably need to rally a little bit. And the breakout might fail, but once you get 46 and 47, there's an increased chance. Those are your breakout bars, right? High chance we're going to get a second leg from this. So you can buy these closes and basically hope that we get a rally all the way up to bar 15. I say hope because it's not necessarily a high probability that you're going to get this type of rally. But after this many bull bars, 8, 9 bar micro channel, we're probably going to start to go pretty sideways and not get an immediate second leg. So one of the problems people run into is they see this rally and they think, okay, it's going to get a second leg, and they try to buy the high 2 somewhere over here, maybe a high 3. But that's not a good idea. You're high in a trading range, and this oftentimes if you get a rally that's 38 to 53, 15-ish bars, you have to expect that the pullback is going to be 20 to 30 bars. A lot of times the pullback from a protracted move like that is, twice the amount of bars of the move. But in general, when you get wedges, or when you get a rally over the course of the first 20 to 30 bars of the day, you can expect a pullback that's 20 to 30 bars. So that's why when you get those early rallies to maybe bar 18, you expect the market to pull back until maybe bar 41, 42 and get some sort of midday reversal. But you can see here, if you bought for any reason, and you just held waiting for the second leg, basically thinking, okay, this is going to get a second leg. You could have had this could be the second leg, since 60 traded one tick beyond the extreme of the bar 54 high, but it's not necessarily likely. You're probably going to get a better second leg than that after all of this. But this is the problem, is you can sit through these deep pullbacks. So if you kept your stop below 38 and you're buying all the way up and you held through the pullback, you would have gotten your second leg, and obviously get the gap up as well. You would have gotten your second leg. It's just that it's obviously, do you want to sit through this? No, not really. When you're sitting here and you're long and you can see the close of bar 66, how much trust do you have mentally in the fact that this is going to get a second leg? I don't know. And you build that trust by basically doing it, obviously, but you can see why it's difficult to hold through these sorts of pullbacks for second legs. So it's not always optimal to just buy the close and hold. And you can see the swing point, the bar 38 high, the swing point is where the swing trade started, and that would be bar 38. Sometimes in trading ranges, you come back and test those swing points. And you can see we got a small second leg here because top of a trading range, not a great second leg. Bottom of a trading range, not a great looking second leg, 69. But 69 touching the close of 67 is the absolute bare minimum that traders are going to get as far as second legs. That's unusual, especially when you get a leg this big. but the context for it made sense because it's the bottom of a trading range, and we just had a big rally. Now it's a big sell-off, probably sideways. Finally, we have trades that are three pushes. So when you get three pushes in one direction, it's often called a wedge. And a lot of time, wedges are minor reversals. So when people read about wedges and they think about reversal patterns, they think to themselves, okay, I'm gonna start trading wedges. I'm gonna start trading these reversals. But it's often way better to just trade the higher probability breakouts that we discussed. 2, 3, 4 bar microchannels are what you want to trade because there's a high probability they're going to get a second leg. But you can just learn to exit when there's a wedge and sit out of the minor reversal rather than trying to trade the minor reversal to make money, because it's really hard to do. So one of the problems people run into is they see a wedge and they correctly identify it's a wedge, but they don't actually know what to do with that information. Just because you can see three pushes in one direction and you know it's a wedge doesn't mean it's a tradable pattern, and it doesn't mean you're going to make money on it. You only have half the battle there. You have to think about your calibrated expectation. You have to think about context. Just identifying the pattern correctly doesn't mean that you're going to be able to make money trading it. So we're going to talk about a few examples. I'm going to go over this example first and talk about a time where there is a wedge, but it's really not tradable. Before I do that, this is going to be a half day, I believe, but it's going to be a half day today, but this is a live chart. Obviously right now you can see the market's open. It opens at 7:30 since I'm Mountain Standard Time. And you can see we got a surprise on the open, but this is one of those times where the surprise ends up not being reliable. You have a gap up, but you're so far above the moving average, you probably want bar 3 to get follow through. So instead of buying the close of 3, some traders will buy below 3. Some traders will wait till we get a measured move down, maybe down to there, something like that, and they'll buy there for a scalp back up. We have 4 straight bear bars here. You know this is going to get a second leg, sell off down to bar 7. So traders, maybe they sell above 8 because they know 8's a minor reversal. Maybe they sell the close of 7. They sit through 8 because 8 doesn't have any of the qualifications for a second leg that we just mentioned. But anyways, this is a good example. And as I mentioned a minute ago, how often you get second leg from the low. I found a little example of that. Bar 23 is a climactic bar after a few legs up. So it's probably better to buy below 23 than it is to buy the close of 23. As you can see, we rallied back to that close, the bar 23 close during 28, and then we got another leg up back to the high. This is a good example of 3 legs up. 1, 2, 3. And so you look at 8 and you might have said to yourself, oh, this is a wedge. Great. I know this pattern. I studied this pattern. And you're not wrong. It is a wedge. But if you're selling below 8, you're selling, first off, after a couple of pretty solid bull bars, bar 3 and bar 7. You know bar 7 is a big enough surprise to get a second leg. Hence bar 9 and bar 10, the bad follow through if you're selling below bar 8. And all you're really expecting to get from bar 7 is a second leg down. And you can see bar 11 is your second leg down. It went below 1 tick beyond the bar 9 low. And if you're sitting there saying to yourself, well, that's not really a very good move, you're right. It's not really a tradable move. And so if you sold below 8, all you were in, your entire premise was, I'm going to get a second leg down, then you got it, but you probably lost money on the trade because it's too difficult to manage. So you have to learn the context in which it's okay to look to trade wedges. And this really isn't one of them. We have a gap up and lots of good bull bars. So really better not, it doesn't mean buy below 8. It just means wait. And then after you get the second leg down, you get a reversal up bar 12, 13, 14, 3 consecutive bull bars. This is probably going to need a second leg. In general, a breakout above 3 pushes is a breakout above a bear flag. So this is a bear flag. The bear's hoping. It's a bull flag. You're getting a breakout above a bull flag, generally pretty 50-50. Basically, a breakout above a wedge. Expect it to be pretty 50-50. And if you're buying the close of 14, you're buying above 16. What are you expecting? Well, you're expecting for the bears to not get a bar that needs a second leg. So if the bears have any of the things that I mentioned earlier that might need a second leg, then you can exit below. And when do we get that? Well, 25. So 25 is a big enough surprise for a second leg. You put a stop below 25. It doesn't get filled until over here, or you could just exit below bar 29, since that is probably also big enough for a second leg. For the last example, I just wanted to go over this right here. We have a bear channel, so a large bear channel down. When you're deep in a bear channel, especially one with lots of good bull moves, it's a little bit more likely that you're going to get a reversal. Obviously, If the bear channel is really tight and really strong, something like this, then the reversal is very likely to fail. Again, look at these breakup bars. You can buy these closes and just exit when the bears need a second leg. Does 18 need a second leg? I don't know, probably not. But if you do exit below 18, you can just buy again above 19. But as I was saying, when you're getting all these reversals up in the bear channel, you know that a breakout below the bear channel is unlikely to succeed. Maybe only 25% chance. 75% chance you test the other side of the bear channel somewhere up here. So in this context, selling these consecutive bear bars, these breakout bars, doesn't make sense. It's a third leg down. 1, pullback, 2, pullback, 3. We just got 3 pushes up. 1, pullback, 2, pullback, 3, and now 3 pushes down. 1, pullback, 2, pullback, 3. So 3 pushes up, 3 pushes down. A wedge correction. We might have to rally somewhere back up into this area. Traders will buy above 9 and put a stop below, knowing we're probably going to get a couple of legs sideways to up. And since this bear move, this bear channel was so large, 60, 40, 50 bars, whatever it was, you can buy expecting, at least 20 to 30 bars in your direction, potentially, right? If the swing is to work, that's what you should get. Doesn't mean it's going to work immediately, right? But if the swing is to work, you're going to get 20 to 30 bars in your direction. So that's why you would take that swing. It's not necessarily high probability, maybe 50-50 chance you get it. But if you do get it, you obviously make a lot more than you lose. So there are certain contexts, basically failed breakouts below channels and failed breakouts above channels are good contexts to trade wedges, and really bad context for the consecutive breakout bar type of trade. But if there's one thing you should remember, it's just enter the market when your side needs a second leg and exit when the other side needs a second leg. And you're not going to master this tomorrow. It's going to take, if you simply decided all that 2025 is, first off, I think it's a good idea what I'm about to say. That's why I'm saying it. But if you decided all that I want out of 2025 is to learn how to trade consecutive bull bars or consecutive bear bars or 2 or 3 bull bars or 2 or 3 bear bars, whatever it is, if you decided that's all you want to learn how to do in 2025, you'll probably get pretty good at it. And you might even learn how to make money by the end of it. But one of the issues people have is they try to learn how to trade wedges and then double tops. And there's hundreds of patterns and they're trying to learn how to trade them all rather than master 1 or 2 to make money and then expand off of that. The best thing you can do is grab, basically figure out 1 or 2 patterns and then learn how to trade them after. And that's what I mentioned with the 4-bar micro channel study that I've run earlier. I picked, four bull bars. I get 26, 27, 28, 29. I buy the close of 29. I go for a measured move and basically just sit through all the pullbacks because none of them are major. And that's more or less the point of that type of trade that I that I did a bunch of research on. But anyways, that's going to be it for this video. Again, I think it's probably a confusing video, but try to pick 1 or 2 things to learn and just focus on those things.